So as you know, I don't trade on impulse. I got to see a repeatable pattern, one that's understandable, unemotional, and one that's made consistent profit over time. Today, I want to show you a pattern that's off the beaten path, but it's one that's proven successful over time. A pattern I call sell the contraction. Hey everyone, Tom Gentile here. Our best guide to successful trades is historic performance. If you can find a stock that repeatedly rises or falls into or out of earnings, you got a good history of repeating itself again. As I've spoken about before, this is the heart of my trading directional earnings trades. Getting direction right most of the time using history and amplifying profits with the rush of volume. Now, going off the beaten path means, can we do this outside of earnings? And the answer is yes, as long as it's event driven. So think of an overhyped company or an overhyped product that's been in the news recently. Here's one, Ozempic. Now, this product is leading the charge against weight loss. Wasn't originally that. It was used to fight diabetes, but it had a side effect, major weight reduction. Now, this is one of the oldest patterns in the book. I call it the 4 stages of an economic cycle. So take a look at this. The 4 stages are stage 1, expansion. This is where an example of a manufacturer might make a good product for use. Then they find out that it can be sold to a broader base with a different, more popular storyline. Stage 2 is peaking. Company changes its marketing strategy, creates demand, outstrips supply, and the company's stock price has risen during a time frame. Contraction occurs when the product matures, where supply meets or exceeds demand. Side effects are found, maybe lawsuits are filed, public acceptance becomes public outcry, stock price drops, and finally we get to stage 4, the trough. Now this is where the company's been on hard times for a while, and maybe executives are now testifying on Capitol Hill. The company settles any lawsuits it has, management changes, those take place. The stock price finds a bottom, and let's not forget, the government and its representatives take a victory lap. So this is kind of what's happened right now with many companies. Boeing, just to come up with an example right now. Take a look at Boeing. I mean, this is a chart of Boeing where we've gone from cheap money back just after COVID to the area where 737 had problems, and couple that with interest rates rising at a rate that we haven't seen in decades. Now, coming out of the end of 2022, we started seeing more flight demand happening as we were seeing more people wanting to get out after COVID. More recently, we've had new problems with emergency doors popping off and other problems related to Boeing aircraft. It's starting all over again, folks, but let's talk about a new developing story with Ozempic. Think about this. This was a product that was created for type 2 diabetes, which currently, by the way, represents about 8% of the US population. Now, turn that into an obesity drug, and what you've done is you've 5x'd your customer base. According to Wikipedia, 40% of the US population is now considered obese. Now, I don't see a lot of type 2 diabetes commercials, but that Ozempic commercial continues to play out in my head like an earwig. Take a look at what I have as the projected Ozempic cycle. Right now, Ozempic and Wegovy, I think they're in that final expansion phase right now. And where and when do they peak? Well, it's anybody's guess. But remember, the market's usually ahead of the news by about 6 months, give or take. So who's the player in this field most likely to rise and or fall during these phases? Well, Novo Nordisk, that's who. A quick chart on Novo Nordisk, and you can see that it's been up about 68% in the last year. But look at what's happened recently. As of the last month, this stock has already peaked out at around $136 a share. Volatility's been creeping up too. Now, this tells me that the institutional, large spec traders, they're already in this phase. And with all the hype that's been coming in and all the mainstream media that's played out on Ozempic and Wegovy, it's only a matter of time before the majority of the retail traders get sucked in. You know what that means? That means the end of the trend, my friend. So How does one take advantage of a potential drop in this industry or the stock for that matter without shorting it? Well, use options, of course. With IVs up, it means option prices are higher than normal and selling out of the money options like call spreads, for example, give us a high probable trade with limited risk. Here's how it works. Take a look at this option chain I have here. These are the options of NVO. They're the April 19th options, although there are many more expiration dates and many more strikes. I want to use this as a case study. With NVO trading just below 130, an option trader could sell those 130 calls that are overpriced and at the same time buy, for instance, a higher strike call like the 135s as protection. So once again, what are we doing? We're selling the lower strike call. We receive a credit for the sale. At the same time, we're buying the higher strike call as a debit, and that protects us in case we are wrong. The combination of the two produces a small credit. Now, if the stock in question stays the same or goes lower by expiration, we keep the credit. If it goes higher, worst case scenario is that we risk the difference between strikes minus what we took in as a credit. So let's look at this case study once again using NVO. Now, this is an example of a call spread order that would be placed on NVO, buying the April 19th 135 calls and selling the April 19th 130 calls for a credit of $2. Now, you might ask, why risk more than you bring in? Well, it has to do with something called probability, which is near 60% right now. So 60% probability make 40% of the spread. There's no statistical edge, but we're not trading statistics here, folks. We're trading a repeatable emotional pattern using a non-emotional trade. So in summary, though history isn't perfect and is no guarantee, it's often repeatable. You've just learned how to buy the rumor, sell the news, and what I like to call buy the expansion, sell the contraction with an option strategy as an alternative instead of shorting the stock. Hope you enjoyed the video. We'll see you again soon. Bye now.